Ladies and gentlemen, welcome back to another episode of Investing for the Common Man, the channel where we learn how to save not only our money, but more importantly, our time with short, concise, instructional videos. I recently completed a video series covering all the basics of options. In the next series, I'll be covering individual option strategies. It is one thing to understand the anatomy of an option strategy, but in these videos, we're also going to cover how and when are the best times to use these strategies for maximum effect. You can add new option strategies to your arsenal one at a time, slowly developing mastery until you eventually feel comfortable using options to manage risk and trade in any market condition. In this first video, we'll take a deep dive into the long call option strategy. We'll look at the advantages and disadvantages of buying simple call contracts, as well as what sort of setups to look for when using this strategy, and how to choose your strike price and expiration date. We'll cover how to manage an open long call position and when to close the position to maximize your profits. Before we get started, please take a moment to smash that like button to help more people find these educational resources. Alright, let's dive in. The long call option strategy is a good place to start because it's one of the simplest and most intuitive to understand. Buying call contracts is also a popular strategy because your potential maximum gain is always infinite, which is why you can typically find the reckless traders over at Wallstreetbets salivating over this strategy. But all kidding aside, this strategy can potentially be very lucrative, but in an efficient and well-balanced stock market, that potential doesn't come without a high level of risk. If you remember back to my introduction to options series, you know that by purchasing a call contract, you are buying the right, but not the obligation, to purchase 100 shares of the underlying stock at the specified strike price anytime between now and the contract expiration date. The intention of this strategy is simple. The only reason you would spend money on the premium to secure a price to buy a stock in advance is if you believe that the market price of the underlying stock will be significantly higher than your contract strike price sometime before expiration of the contract. In essence, if your assumption is correct, you'll be able to purchase 100 shares at a massive discount. In other words, this is the strategy to use if you're bullish as a Matador on a particular stock. This becomes very clear when you look at the risk-reward profile for this strategy. On the risk side, your maximum loss is 100% of your investment. This is the premium that you pay to purchase the call contract. But on the reward side of this trade, your maximum gain is technically infinite. You may notice that this shares some resemblance to the risk profile of a long stock position with a few key differences. A long call is a leveraged position, meaning that with a relatively small capital requirement, you can gain exposure to the appreciation of a much larger asset. In this case, 100 shares of stock. This means that the profit side of this chart increases at a much steeper rate than that of a standard stock position. The downside is that to take the maximum loss on a long call position, the share price of the underlying stock does not have to go all the way to zero. At expiration, after all the extrinsic value of the contract has melted away, if the price of the underlying stock is below the strike you selected, the option will be completely worthless. This is where the degenerates over at Wallstreetbets tend to get themselves into trouble. I'm really not trying to rag on Wallstreetbets, but in this video, I want to show you a few more prudent ways to use this strategy so that you can still taste some of those juicy gains, but greatly reduce your chances of taking maximum loss. Before we dive into specific trade examples, let's take a moment to consider what the Greeks have to say about this strategy. This is obviously a delta positive strategy, meaning that you profit as the underlying stock increases in value. But it is just as important to note that long calls are theta negative and vega positive. Negative theta means that the passage of time works against this strategy, causing your contract to lose value for every day that passes. Positive vega, on the other hand, means that increasing implied volatility works in your favor and decreasing implied volatility works against you. It is for this reason that buying a call contract right before a company reports earnings is usually not the wisest strategy. The anticipation of earnings reports often causes implied volatility to skyrocket because the market does not know if the company will report positive or negative news. But after the report, this implied volatility will return to normal levels, causing your option to lose a substantial amount of value even if the stock increases slightly on good news. A better tactic is to buy a call contract the week before the earnings report with an expiration date after earnings, and plan to sell the option back before the company actually reports in hopes that the stock will increase in anticipation of the report. If the stock trades higher going into the report, you can sell your option before the IV crush and profit nicely on both the move in the underlying stock and any increases in implied volatility. This is an example of employing the age-old market wisdom, buy the rumor, sell the news. Another way to use the long call strategy is to pick a contract that is at the money or slightly out of the money and has between 30 and 60 days left until expiration. You could even go a little bit further and aim for 60 to 90 days if you want to, but you're going to have to cough up a little bit more premium for the extra time. You want to use this strategy when you expect the stock to make a strong move to the upside sometime within the next month. You don't want to hold this contract all the way until expiration because you don't want to wait for all that extrinsic value to melt away. Sometimes if I'm using this strategy and the contracts aren't too pricey, I'll buy 2 or even 3 contracts. If I see a nice appreciation within the first few days of the trade, I'll sell one and secure some profits and let the other 1 or 2 run. Recently I used this strategy by buying 3 September calls on Raytheon Technologies, ticker symbol RTX. I sold the first call back after a few days with about a 50% gain, and then the second call after a week with a 150% gain. With those solid profits secured, I can feel confident letting the last contract run for several more weeks because I've already made more in profit than I can possibly lose on the remaining contract. It's like playing with the house's own money. Alright, let's look at one last method of playing the long call strategy. The most conservative method of buying call contracts is to buy a call with a strike price that is deep in the money and has a significant amount of time before expiration. These types of options will be much more expensive because they have large amounts of both intrinsic and extrinsic value. This method works best on securities with low levels of volatility, which will drastically reduce your cost basis. Most people use this approach as a stock replacement. The deep in the money option will have a higher delta value, which will cause the option to more closely imitate the price action of actually holding 100 shares of the underlying stock with a lower capital requirement than actually purchasing the stock outright. By choosing an option that has a distant expiration, theta will be very low, causing the extrinsic value of your option to erode away at a slower pace. Call options that have more than 9 months left until expiration are commonly known as LEAPs, which stands for Long-Term Equity Anticipation Securities. The downside of using a call contract as a stock replacement is that you will not receive any dividends that the stock may pay out to shareholders. With any long call, you really want to sell your contract well before it expires so you can get back a portion of the extrinsic value that you paid for. As with any option trade, before you enter a trade, you always want to plan your exit. Ask yourself, what is your target return? Is it a dollar amount or a percentage of your initial investment? What is the maximum you're willing to lose? 5%? 10%? You need to ask yourself these questions and develop a plan so that you don't allow your trading decisions to be fueled by emotion when things go wrong. And trust me, there will be times when things go wrong. Whether you're just starting your options education or a veteran, I hope that this in-depth strategy guide has helped you understand the strategy better or at least given you a few new ideas on how to use it. If you have any questions about this strategy or some sweet gains you're dying to share with the community, let me know in the comments below. Before you go, please take a quick second to support this channel by hitting the like button and subscribing to the channel so that you don't miss the rest of this series on option strategies. Until next time, keep calm, stay healthy, and happy trading.